In 2008, as the world watched financial markets crumble and global giants fall, one man reportedly made over $3 billion by doing nothing. While others panicked, he stayed calm. Why? Because he had a principle most people ignore. Investing isn't about timing the market. It's about tempering your emotions. Now imagine this. What if the secret to long-term wealth wasn't found in flashy headlines or hot stocks, but in discipline, patience, and a deep understanding of human behavior? That's exactly what Benjamin Graham, the mentor to Warren Buffett, believed. And in his timeless classic, The Intelligent Investor, he reveals how ordinary people, with the right mindset and method, can navigate even the most chaotic financial storms and still come out ahead. This isn't just a book about money, it's about how to think like an investor, how to protect yourself from your own worst instincts, and how to build wealth that lasts beyond trends, hype, or luck. So, whether you're a seasoned entrepreneur or a busy professional trying to make your money work smarter, this book offers something rare: wisdom that works in any economy. In this book Bytes summary, let's explore the timeless lessons of the intelligent investor and discover how you can turn smart thinking into real financial strength. Lesson 1. Intelligent investors don't rush in. They take time to rationally examine a company's long-term value. You know, the stock market can feel like a roller coaster. Headlines screaming, prices jumping, social media buzzing with hot tips and overnight success stories. It's tempting to just jump in and grab your slice of the action. But here's the truth. Successful investing isn't about hype, speed, or luck. It's about patience, clarity, and good judgment. Let me ask you a simple question. If someone offered you a used car for $10,000, would you buy it without checking the engine, asking about mileage, or looking up its market value? Of course not. And yet, millions of people buy stocks this way every single day, based on tips, trends, and Twitter threads, with little to no research. This is where intelligent investing draws a sharp line in the sand. Unlike gamblers chasing short-term gains, intelligent investors are calm thinkers. They don't follow the crowd, they study the map. Their goal isn't to win big overnight. It's to build wealth sustainably over time. And they do this by understanding one core idea: the difference between price and value. Here's how that works. Imagine walking into a bookstore and spotting a rare, beautifully bound edition of your favorite novel. It's priced at $20. But you know, from researching online, that this same edition typically sells for $60 to collectors. That's a deal. That's value. Intelligent investors are essentially doing the same thing. Not with books, but with businesses. They look at companies the way a scientist might examine a new discovery, carefully, methodically, and with questions. What does this company actually do? Can it grow in the long term? Are its profits stable? Does it have strong leadership and a defensible market position? And most importantly, is its current stock price lower than what it's truly worth? This difference between the true worth of a business and the price you're repaying is called the margin of safety. And it's not just financial jargon, it's your buffer, your protection against being wrong. Because let's face it, no one can predict the future, not even Warren Buffett. But what separates intelligent investors from speculators is their discipline in only buying when the odds are in their favor. Let me give you a global example. During the financial crisis of 2008, panic flooded the markets. Stock prices were plummeting, but some investors saw beyond the chaos. They noticed that certain strong companies, like Johnson & Johnson or Coca-Cola, were still making profits, still had loyal customers, and still had sound fundamentals. Their stock prices had dropped not because the businesses had failed, but because everyone was selling everything in fear. So intelligent investors stepped in, calculated the intrinsic value, and saw a safe margin. Years later, those decisions paid off handsomely. Now compare that to speculation. Speculators chase rumors, trends, and predictions. Maybe someone whispers that a certain tech company is launching a game-changing gadget next quarter. A speculator buys in fast, hoping to ride the wave. But if the launch flops or gets delayed, the stock sinks, and so does their money. It's like betting on weather. Sometimes you are right, but when you are wrong, you pay for it. Here's the catch though. Speculation feels exciting. It gives you that adrenaline rush, that shot of dopamine when things go right. Intelligent investing? Not so much. It's slow. It's even boring. At times. But guess what? That's the beauty of it. Because the goal isn't to be entertained, it's to be rewarded. So if you're really serious about building wealth, not just chasing money, start thinking like an owner. Ask, would I buy this business if I had to hold it for 10 years? If the answer is yes, and the price is right, you're on the path to becoming an intelligent investor. In the next part, we'll explore how emotions often sabotage even the smartest investment decisions, and what you can do to protect yourself from your own brain. Stay tuned. Lesson 2. Intelligent investing is broken down into 3 principles. Let's talk about a timeless truth. Building wealth through investing is less about chasing hot stocks and more about adopting the right principles. Principles that keep you grounded, rational, and prepared for both good and bad times. Think of it like flying an airplane. You don't take off just because the weather looks nice for the next hour. You check the whole flight path, fuel levels, backup plans, the entire system. Investing works the same way. It's not about what's trending this week. It's about understanding how strong the business is behind that shiny ticker symbol. So let's break down 3 powerful principles that smart investors around the world live by. Principle 1. Always study the business. Not just the stock. Let's say you're thinking about investing in a company. Maybe it's a sleek startup or a well-known brand. Before you dive in, pause. Ask yourself, how does this business actually make money? Is it profitable, stable, and run by trustworthy leadership? This isn't about looking at just last quarter's earnings or flashy headlines. It's about zooming out and asking, is this company built to last 5, 10, even 20 years? For example, think of a company like Unilever or Nestlé. They may not be in the news every day, but they've consistently paid dividends and shown steady growth for decades. That consistency tells you a story that price charts can't. In fact, some of the best opportunities lie in boring companies, the ones no one talks about at dinner parties, yet have a proven track record, solid cash flow, and reliable returns. Like that one friend who may not be flashy, but always shows up when it counts. Smart investors buy these companies when they're underpriced, when their stock value is temporarily low, even though the fundamentals are strong. That's where real opportunity lives. Principle 2. Don't bet the farm. Spread your risk. Here's a scenario. Imagine putting all your savings into one single company, and then boom, a scandal breaks out, or a sudden industry disruption sends the stock crashing. Just like that, your financial safety net evaporates. That's why intelligent investors never rely on a single bet. They diversify, meaning they spread their money across different industries, countries, and asset types. It's like building a table with multiple legs. Even if one leg breaks, the table doesn't collapse. Take Ray Dalio, one of the most respected hedge fund managers. He often says, diversification is the only free lunch in investing. And he's right. A well-diversified portfolio cushions you against shocks, surprises, and even economic meltdowns. Principle 3. Temper your expectations. You're not here to get rich quick. Let's be honest. We all dream of that magical stock that doubles overnight. But here's a cold truth. Chasing big wins often leads to big mistakes. Intelligent investors don't play that game. Their goal isn't to beat Wall Street or become millionaires in a month. Their focus is on consistent, modest gains that stack up over time. Imagine planting a fruit tree. You don't water it one day and expect mangoes the next. You nurture it season after season, and over time, it becomes a reliable source of food. Investing works the same way. The best results often come to those who stay patient, not those who chase the wind. Bonus wisdom. Know the market's past before you bet on its future, before you pick your next stock. Don't just look at how it's been doing recently. Look at the broader market history. Because here's the deal. The stock market has never been a straight line. It climbs, it dips, it crashes, and it recovers. Look back at 1929, 1987, 2000, 2008. Each time the market took a hit, panic flooded the system. But each time, it bounced back. That's the rhythm of the game, and understanding this cycle helps you stay calm when everyone else is losing their heads. During COVID-19's market panic in early 2020, for instance, many investors sold off in fear. But those who had studied history knew better. They held on. Some even bought more. And sure enough, the market rebounded dramatically within months. So, learn from the past. Use it to strengthen your psychology. Investing isn't just financial, it's emotional. When fear kicks in, history can be your compass. Final thought. Think long-term. Think logically. Here's one last insight to chew on. Imagine earning 7% return on your investment. Sounds decent, right? But if inflation is eating away 4% of your money every year, your real return is just 3%. That's why every intelligent investor factors in the real value of money, not just the numbers on the screen. So whether you're just getting started or fine-tuning your strategy, remember this: you're not just investing in stocks. You're investing in businesses, in time, and most of all, in your own patience. Stick with the principles. Coming up next, we'll talk about how emotions, greed, fear, and overconfidence can quietly destroy even the most well-thought-out investment plans, and how to outsmart them. Stay tuned. Chapter 4. Don't trust the crowd or the market. Great. This chapter introduces the idea of Mr. Market, an allegorical figure that helps us understand the psychology of the stock market. Now, let's turn this into a completely original, podcast-style script with a conversational tone, global relevance, and clear storytelling. It'll flow naturally from the previous chapters and keep listeners engaged. Podcast script. Chapter 3. Outsmarting Mr. Market. Let's imagine for a moment that the entire stock market is a person, not a spreadsheet, not a chart, a human being. Meet Mr. Market. Now, Mr. Market is no ordinary guy. He shows up at your door every day with a new price tag for the stocks you own. But here's the catch. He's wildly emotional. One day, he's beaming with joy, throwing out ridiculously high offers for your shares. The next day, he's gloomy and wants to sell you everything at bargain bin prices. No logic. Just vibes. Sound crazy? Well, welcome to the world of investing. The emotional rollercoaster of market psychology, you see. Mr. Market isn't wise. He's not a fortune teller. He reacts to rumors, headlines, hype, and fear with the emotional maturity of a teenager who just lost their phone. Think about the frenzy every time a new iPhone is about to launch. People line up, media buzzes, and expectations shoot through the roof. Stock prices for Apple or suppliers often jump, not because the numbers say so, but because Mr. Market is excited. He imagines future profits before they even exist. Then months later, one missed earnings report or a small decline in sales, and boom, Mr. Market panics. He starts shouting, "Sell. Sell now." The same stock that once felt like gold suddenly feels like a sinking ship. But here's the golden rule. You are not Mr. Market. You'd have to feel what he feels. Chapter 5. The defensive investor's portfolio should be well balanced, safe, and very easy to manage. The first big decision you'll face isn't about which hidden treasures to hunt, but rather, what kind of ship you want to captain. Are you the daring adventurer constantly seeking new horizons, unwilling to brave any storm for potentially massive rewards? Or are you someone who prefers a sturdy vessel, prioritizing safety and a calm journey, even if the riches might accumulate a bit more slowly? Today, we're recharting a course for the latter, the defensive investor. Think of it like this. If investing were a sport, the defensive investor would be the strategic player focused on a solid defense, minimizing risks rather than making spectacular, high-stakes plays. For them, the mantra is clear. Safety first. Now, how do you build this fortress of safety in your investment portfolio? The cornerstone is diversification. Not putting all your eggs in one basket, as the old saying goes. But for the defensive investor, it's not just about having a few different baskets. It's about having fundamentally different types of baskets. We're talking about a blend of high-grade bonds, which are essentially loans to very creditworthy entities like stable governments, and common stocks, which represent ownership in established companies, giving you a say in their major decisions. A classic approach is a 50-50 split, like having two equally strong hulls on your ship. For those who are truly averse to any rocking of the boat, a 75% allocation to the calmer waters of bonds and 25% in stocks can also be a viable strategy. Think of bonds as the reliable engine of your ship, steady and dependable, providing a consistent, if perhaps less dramatic, return. Stocks, on the other hand, are like the sails. They can catch powerful winds and propel you forward at a faster pace, but they are also more susceptible to the unpredictable gusts of the market. By having both, you balance stability with the potential for growth. But the diversification doesn't stop there. Even within your stock portfolio, it's crucial to spread your investments across a range of well-established, large companies with a proven track record. Imagine investing in the giants of the global economy, companies whose names you recognize, whose products you might use every day, and who have weathered economic storms in the past. Aiming for at least 10 different companies helps to further cushion your portfolio against the specific ups and downs of any single business. Now, this might sound like a lot of research, but here's a clever shortcut for the defensive investor. Instead of trying to be a stock-picking guru yourself, why not learn from those who have navigated these waters successfully for years? Look at the portfolios of well-established investment funds. The ones with a long history of solid performance. It's like studying the routes of experienced sailors who have consistently reached their destinations safely and with good returns. This isn't about blindly following the latest investment fads. It's about learning from a proven track record. Finally, remember that even the most experienced captains often consult with navigators and weather experts. In the world of investing, this translates to seeking the guidance of a financial advisor. They possess the expertise to help you chart your course, understand the currents of the market, and make informed decisions aligned with your defensive strategy. By following these principles, the defensive investor sets themselves up for a journey where prudence and patience are the keys to long-term success. So, with your diversified portfolio and a trusted advisor by your side, you're well-equipped to navigate the investment seas with confidence. But once you've chosen your fleet of investments, what's the best way to keep your journey on course? That's where the power of a consistent, almost automatic, investment strategy comes into play, which we'll explore next. Final summary. So, we've journeyed through the fundamental principles of intelligent investing, exploring both the cautious path of the defensive investor and the more adventurous route of the enterprising individual. But regardless of which approach resonates most with your risk tolerance and financial aspirations, the overarching message remains clear. In the realm of stocks, the most reliable compass you can have is the mindset of the intelligent investor. It's not about chasing fleeting trends or getting caught up in market hype. It's about grounding your decisions in rational analysis, understanding the difference between price and value, and maintaining a long-term perspective. By diligently applying the guidelines we've discussed, whether it's the diversification and steady approach of the defensive investor or the calculated risk-taking and bargain hunting of the enterprising investor, you too can aim to transform your investments into a source of steady and sustainable growth. It's a marathon, not a sprint, and consistency, coupled with informed decision-making, is the key to crossing the finish line with modest yet dependable profits. Now, as you embark on this path of intelligent investing and begin to witness your wealth gradually accumulate, it's worth considering a crucial aspect that often gets overlooked in discussions about finance: the potential impact of money on one's character and values. In The Education of a Value Investor, Guy Spier, a successful Wall Street hedge fund manager, shares a powerful and introspective journey. At the pinnacle of his career, he experienced a profound realization that in his pursuit of financial success, he had inadvertently compromised his ethical compass. His story serves as a potent reminder that as we navigate the complexities of wealth accumulation, it's essential to remain grounded in our values and to be mindful of the person we are becoming along the way. If you are curious to delve deeper into Spear's transformative experience and learn about the extraordinary lengths he went to for an opportunity to learn from the legendary investor Warren Buffett, exploring the insights from the education of a value investor could be a valuable next step in your financial and personal growth journey. And finally, as we conclude this exploration of intelligent investing, we'd love to hear about your thoughts and takeaways. Your feedback is invaluable in helping us refine and improve our content. Please feel free to share your ideas and thoughts in the comment below. If you like the video, bring a smile to my face by liking the video and subscribing to my channel. See you in the next video. Lesson 7. Enterprising investors start similarly to defensive investors. So, you've got a taste of the steady, secure approach of the defensive investor. Now, let's shift gears and talk about those who are ready to navigate the investment waters with a bit more ambition and a willingness to explore potentially higher yielding, though admittedly choppier, seas. This is the realm of the enterprising investor. Think of the enterprising investor as someone who, having learned the fundamentals of sailing with a sturdy vessel, is now ready to outfit their ship with larger sails and explore routes that might lead to richer discoveries, accepting a bit more risk along the way. Interestingly, the journey for an enterprising investor starts with a familiar foundation. Just like their defensive counterparts, they understand the importance of dividing their resources between bonds and common stocks. Bonds still provide a level of stability, acting as an anchor in their portfolio. However, the enterprising investor, with their greater appetite for growth, will typically allocate a larger portion of their capital to common stocks. They recognize that while stocks can be more volatile, they also offer a higher potential for significant returns over the long term. It's a strategic tilt towards growth, acknowledging the inherent trade-off between risk and reward. And just like the defensive investor, the enterprising individual understands the value of expert guidance. They too will seek out a financial planner. However, the nature of this relationship is different. Instead of viewing the advisor solely as a teacher, providing instructions, the enterprising investor sees them more as a partner, a collaborator in managing their financial journey. It's a dialogue, a shared decision-making process where the investor brings their own research and insights to the table. Now, here's where the enterprising approach truly distinguishes itself. Beyond the foundational stocks and bonds, these investors are willing to explore other types of stocks that come with a higher degree of risk, but also the potential for more substantial rewards. Think about those whispers you might hear about a promising new startup, a company that could be on the cusp of revolutionizing an industry, perhaps the next global tech giant. For the enterprising investor, these represent exciting opportunities. However, this isn't about reckless gambling. The intelligent enterprising investor approaches these higher risk ventures with careful consideration and, crucially, with strict limits. No matter how compelling a potential investment might seem, they understand the inherent unpredictability of the market. They recognize that even the most astute investors can be caught off guard by economic shifts or unforeseen events. Therefore, a prudent enterprising investor will typically allocate only a small portion of their overall portfolio, perhaps a maximum of 10%, to these more speculative investments. This acts as a safety net, protecting the majority of their capital should these high-growth bets not pan out as hoped. It's like having a small experimental fleet exploring new territories, while the main fleet remains on a more established course. And just like the defensive investor, the enterprising individual understands that the journey doesn't end once the investments are made. Continuous research and diligent monitoring of their portfolio are essential. They need to stay informed about the companies they've invested in, understand market trends, and be prepared to make adjustments as needed to maintain a healthy flow of returns. So, while the defensive investor prioritizes safety and stability, the enterprising investor embraces a more active approach, seeking higher growth opportunities while still maintaining a level of prudence and risk management. They build upon the foundational principles of diversification and expert advice, but are willing to venture into potentially more rewarding, albeit riskier, territories. Both strategies have their place, and the best approach ultimately depends on your individual risk tolerance, financial goals, and the kind of investment journey you're most comfortable navigating. Lesson 8. The enterprising investor doesn't follow the market's ups and downs. Imagine the stock market as a boisterous global marketplace, filled with the constant shouts and cries of buyers and sellers. This ever-shifting sentiment often creates what we might personify as Mr. Market, a sometimes rational, sometimes wildly emotional character whose mood swings dramatically influence stock prices. Now, when you own a share in a company and suddenly see its price plummeting, Mr. Market is likely in a fearful mood, and the instinct for many is to join the crowd rushing for the exits, to sell immediately to avoid further losses. Similarly, when another stock is soaring, Mr. Market is euphoric, creating a fear of missing out, a powerful urge to jump in and ride the wave before it crests. This is the typical behavior driven by the fear of going against the prevailing sentiment. However, the intelligent investor, whether defensive or enterprising, understands that blindly trusting Mr. Market's fleeting emotions can be a dangerous game. They recognize that Mr. Market's prices don't always reflect the true underlying value of a business. Think back to the mid-2000s and the US housing bubble. The market was exuberant, with housing prices relentlessly climbing. Driven by this upward trend, many people poured their savings into real estate, seemingly ignoring the fundamental question of whether these prices were actually justified by the intrinsic value of the properties. It was as if everyone was caught in a collective wave of optimism. But as the disconnect between price and true value became undeniable, the bubble burst, leading to a significant market crash and widespread financial pain. The intelligent investor learns from such episodes. Instead of being swayed by the emotional tides of Mr. Market, they adopt a more contrarian approach. They understand that when prices are rapidly climbing, it's often a sign that a stock might be becoming overvalued, detached from its actual worth, and therefore a potentially risky investment. It's like noticing that the price of a popular gadget has suddenly doubled for no apparent reason. A savvy buyer would likely become suspicious. Conversely, the intelligent investor sees a market downturn, a period where prices are low, and Mr. Market seems pessimistic, not as a time to panic and sell, but as a potential opportunity to buy quality assets at a discount. It's like finding a valuable item being sold at a bargain price during a clearance sale. To navigate this effectively, the intelligent investor engages in consistent research and monitoring of their investments. They don't just buy and forget. They regularly examine the companies they own, asking critical questions. Is the management team still competent and ethical? How is the company's financial health? Is it generating profits and managing its debts responsibly? The key insight is to differentiate between price and value. If an investor concludes that a company in their portfolio has become significantly overvalued, its stock price soaring without a corresponding increase in its fundamental business strength, then the prudent action is often to sell, even if Mr. Market is still enthusiastically buying. It's about locking in profits before the inevitable correction. On the flip side, when the market is down and quality companies see their stock prices fall, the intelligent investor sees potential buying opportunities. Consider the example of Yahoo, Inc. in 2002, when they acquired Intomi Corp. For a mere $1.65 per share. This was considered a steal because Intomi's stock had previously traded at an inflated $231.625 per share during a period when the company wasn't even profitable. A clear case of Mr. Market's irrational exuberance followed by a deep depression. Yahoo recognized the underlying value and seized the opportunity. In essence, the intelligent investor aims to buy when Mr. Market is feeling gloomy and selling at bargain prices, and to sell when Mr. Market is overly enthusiastic and offering inflated prices. It's about having the discipline to go against the crowd, grounded in a rational assessment of a company's intrinsic worth, rather than being swept away by the emotional waves of the market. This independent thinking and focus on value are crucial for long-term investment success. Lesson 9. The enterprising investor has the chance to find real bargains. At this point, the allure of being an enterprising investor, that thrill of potentially uncovering hidden gems and achieving above-average returns, might sound like an exciting intellectual puzzle, a rewarding challenge to take on. But a valid question lingers. Is the extra effort, the constant monitoring and analysis, truly worth the potential payoff? The answer, according to the principles of intelligent investing, is a resounding yes. It's in those less traveled corners of the market, among the companies that Mr. Market has temporarily cast aside, that the most significant bargains often lie. However, jumping headfirst into this arena without preparation would be akin to setting sail on a complex voyage without learning how to read the charts or navigate by the stars. Therefore, the most prudent way to embark on your journey as an enterprising investor is to first engage in a period of simulated practice, a virtual stock-picking apprenticeship. Imagine it as a year-long training simulation where you can hone your skills in identifying undervalued companies and tracking the progress of your virtual portfolio, all without risking a single rupee or dollar of your actual savings. Fortunately, the digital age provides numerous platforms that allow you to engage in this virtual investing. With a simple registration, you can begin to play the role of an investor, making simulated trades and observing how your chosen stocks perform in the real market. This year-long exercise serves several crucial purposes. Firstly, it provides an invaluable education in the intricacies of the investment world, familiarizing you with market dynamics, company analysis, and the often unpredictable behavior of stock prices. Secondly, and perhaps equally importantly, this virtual experience acts as a powerful antidote to unrealistic expectations. The allure of quick riches can be strong, but the reality of investing often involves patience, diligent research, and the occasional setback. By navigating the ups and downs of a virtual portfolio, you'll gain a more grounded understanding of the investment process and temper any overly optimistic notions. Once you've completed your year of virtual practice and ideally demonstrated an ability to identify promising investments and achieve better than average virtual returns, you'll be far better equipped for the real game of bargain hunting. So, where do these elusive bargains typically reside? The intelligent investor understands that the market often undervalues the stocks of companies that are either facing temporary headwinds or are currently unpopular. It's like finding a high-quality product being sold at a discount simply because it's not the trendiest item at the moment. Consider a hypothetical example. Imagine Enterprise B, the second largest player in the refrigerator market in a particular region. For the past 7 years, it has consistently delivered solid, though not spectacular, profits, demonstrating a stable and reliable business. However, due to a temporary production glitch that has impacted their output for the last couple of months, the company's recent profitability has dipped. This news sends skittish investors into a panic, causing Enterprise B's share price to plummet. Now the intelligent investor, having done their due diligence, understands that this production error is a temporary setback. Once resolved, Enterprise B is likely to return to its previous stable and profitable trajectory. They recognize that the market's overreaction to this short-term issue has created an opportunity to acquire shares in a fundamentally sound company at a significantly discounted price. This is the essence of finding a bargain, identifying a discrepancy between a company's temporary unpopularity or challenge and its long-term intrinsic value. However, uncovering these bargains isn't always straightforward. It requires patience, diligent research, and the ability to look beyond the immediate noise of the market. That's precisely why the year of virtual practice is so critical. It's your training ground for developing the analytical skills and the investor's intuition needed to spot these opportunities. Think of your virtual investing year as learning to identify the subtle signs of a hidden gem in a crowded marketplace. If you can successfully navigate the virtual world, if you can learn to identify undervalued companies and track their progress to achieve positive returns in a simulated environment, then you significantly increase your chances of replicating that success in the real world of investing. It's about building the skills and the confidence to become a true bargain hunter in the global marketplace. The intelligent investor thinks, not reacts. Let's say you were offered $10 for your favorite book today. Tomorrow, someone else offers you $100. The book didn't change. Just the emotions of the people bidding on it did. That's exactly how smart investors see the market. Prices fluctuate, not always based on real business value, but based on perception. It's like watching a crowd at an auction where no one really knows the item's worth, but everyone's shouting louder than the last person. So what do intelligent investors do? They stay calm, they observe, and they only act when the price makes sense, not when the crowd is screaming. Why good news can be bad for you? Ironically, the best performing stocks often become the most dangerous. Here's why. As prices rise, demand increases. Everyone wants in on the action. That hype drives the price beyond the company's real value. At that point, it's a bubble waiting to pop. It's like real estate in a trendy neighborhood. Everyone's buying, prices double, triple. But eventually, someone realizes it's all way overpriced. The smart buyers step back while the others get stuck holding the bag. Mr. Market loves creating these illusions. He dangles rising prices in front of you like a magician's trick, and you start believing the magic will never end. The pattern trap, and how our brains betray us here. Something fascinating from psychology. Humans are natural pattern seekers. Show someone a random sequence of numbers or sounds, and their brain will still try to find order in the chaos, even if you tell them it's random. Investing is no different. When a stock keeps going up day after day, we start thinking, this is a trend. It'll keep going. I should jump in now. We trick ourselves into seeing patterns that may not exist, and that's when Mr. Market wins. But let me ask you this. Have you ever bought something on impulse just because everyone else was buying it? Maybe it was a cryptocurrency during the hype, or a hot tech stock during a media storm. How did it feel a few months later? That's the danger of emotional investing. The crowd pulls you in, but the fall can be lonely. What smart investing actually looks like. Let's recap the real takeaway here. Mr. Market will always be emotional. You can't change that, but you can change how you respond to him. And that makes all the difference. Be realistic, not reactive. Base your decisions on value, not vibes. And remember, short-term excitement often leads to long-term regret. The intelligent investor doesn't follow the herd. She waits for clarity. She looks for value. And she understands that price is only an offer, not a command. Not a command.